Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 8. I've had quite a few comments asking for higher time frame applications of ICT's teachings, and fortunately ICT's done that in Lesson 8. So we'll be covering that in this video, so let's jump in. Today's video is Lesson 8 of ICT's 2022 Mentorship Program. And we'll just go through a quick outline before we jump into the video. So the first section will be on the ICT fair value gap on a high time frame. So that'll be using the daily chart on the Euro JPY from about October 2021 to February 2022. And then we're going to look at what's called the ICT New York Kill Zone, and that's going to be using the 15, 5-minute and 3-minute chart. Again, using the Euro JPY from the 10th of February. And as a bonus, we're just going to do a quick look at the London Kill Zone, again using the Euro JPY on the 10th of February 2022. So we're going to start by looking at the Euro Yen on the daily chart. And one of the first things I think is worth noting about this is just the time horizon that we're working over in terms of this particular setup. So, we're looking at data from about October all the way through till, early February. And so that's quite a long time. And I think one of the things that stands out to me about that is that when you're dealing on these higher time frames, you have to be quite patient and you have to be really selective about your trade. So if we use this one as an example, ICT is showing us that the fair value gap's actually formed here at the end of December, but the actual entry doesn't trigger until the end of January. So you're waiting over a month to get set on this particular setup. So I think that's one thing that's just worth noting straight out of the gate, is that trading on these higher time frames often requires a lot more patience. You're going to be taking probably fewer trades than you would if you were on lower time frames. Really makes sense. So I think the thing to really keep in mind is if you're trading on higher time frames, remember you're going to be trading less frequently, the setups are going to come up less frequently, and you're going to be on balance in these trades longer than you will be in other time frames. So if we look a bit more closely at the setup that ICT taught in Lesson 8, where we start is that we have this run down into liquidity here. So we have this sell side liquidity sitting down here, starting all the way back from August into September. We have these relatively equal lows here, and at the lows we're going to have sell stops. This is where traders are going to be going long because they'll see this as support, so they're going to be setting their sell stops below the lows here. So after this run into liquidity, we have these spikes up. So we have these previous highs are actually broken a number of times before our fair value gaps form. So you can see we have a high here which is broken, so we have that break in market structure. We then have another run at the high, so we have this break in market structure again here. We have the market come back down towards the lows before coming back upwards again, and this is where our fair value gaps form. So remember, your fair value gap is a 3-candle formation. So the first candle, second candle, third candle, and the fair value gap is formed between, because this is a bullish fair value gap, is at the high of the first candle and the low of the third candle, and so then the fair value gap is across the body of that second candle. Now if we're looking to set up our order to get set in this particular position, we would have our limit order to buy either at the low of this candle here, or you could have it in the fair value gap itself if you want to try and get a tighter entry, and you would then have your stop down here at the low of this first candle. Now you could use the swing low down here if you wanted to have a little bit more room to protect from a bit of an overrun. That just comes down to personal preference and depending on what your back testing has suggested is going to work best for you. And so you can see after that the market trades up and then back down into this fair value gap before trading higher. Now the interesting thing about this is you can see the fair value gap, the first candle, was on the 20th of December, and the first opportunity we would have had to get into the fair value gap wasn't until the 21st of January, and you had all the way pretty much until the 31st of January to get set. So that's well over a month of waiting to get set in this particular setup. So patience is definitely key. And we can see the market pretty much immediately took off after trading back into that value gap and then ran into this buy side liquidity at these previous highs up here. So while I was marking up the trade from Lesson 8, I actually noticed there was another setup in the data as well. So if we go back a little bit, you can see we had the equal lows here. So we actually had this low here, which ran into this previous sell side liquidity over here, and then the market traded back down to create equal lows. You can see the market created this fair value gap here with this big explosive candle to the upside, and this move broke market structure just here. The market then traded higher before coming back into that fair value gap again, and then trading higher again up to these highs here. So we would look to have our limit either at the low of this third candle here. Remember that our fair value gap is our 3 candle setup, and so we could have our limit to buy either at the low of this candle here or somewhere in this fair value gap here. Then we'd have our stop at the low of this first candle. And so where would we then look to take profits on these two trades? So one of the things we can do is we can take our fib from the range high all the way down to the range low here and look at our 50% midpoint, and there we have a fair value gap or an imbalance there. So remember, in some of the previous videos, ICT talks about using this 50% fib level to find the midpoint, and then somewhere around that point you're going to have a fair value gap, and that should be one of our targets. So in this example, if we look at then taking a trade on this first setup that we had here that we found sort of by accident, you can see if we took our first trade sort of in that fair value gap, so if we just looked at the top of it there, you know, we've got a 1.5R return, so that's not too bad. Or we could be targeting, you know, there's another fair value gap just up here, or closer to the top of the range here. So you can see, as it turned out, the market traded up to about here, so it actually eclipsed that fair value gap there. So if we'd been aiming for that, you know, that would have been about a 2.7R return, so that's not too bad. But in all likelihood, we'd probably be targeting, you know, the highs up here, maybe taking a partial at that first fair value gap, and then closing out the remainder at the highs there. So that's a 2.3R return. So on average, you're probably looking at a 2R return between that partial there and closing out the rest of the position there. And so if we look then at the second position, if we were entering here, if we run our fib down again from that range high to the low, you can see if we run along here, there's actually a fair value gap just there. And there's actually another one just up here as well. And so if we looked at taking our profits along there, just quickly set this up, you can see if we'd targeted that first fair value gap, you know, it's not a great return. Oh, it's not too bad. So it's about 1.7R return. And then if we were looking at potentially targeting this fair value gap up here, you know, that's a 3R return. So that's a pretty great return there. Or alternatively, you know, we could be targeting that buy side liquidity up here just before we traded back down into that fair value gap, and that's about a 2.9R return. So there's a much better return on this particular trade just because the risk is a bit tighter. And so if we're looking now to trade down into a lower time frame, so if we're looking next at going to the 10th of February, so this is data up to the 9th, and so we'd be looking at what's our bias going into that 10th of February trading period. And so given where we are, we've consolidated now after this run, and so our expectation should be is that we're going to continue to reach for this buy side liquidity. And now the thing to remember is that it doesn't actually matter if price trades up to this point or not. It's just that the fact that's where we think price is going to draw towards. But this is where we're aiming at. We don't necessarily have to hit it. It's just where we're aiming towards. And so this is an easy way of setting ourselves into the bias. We're just really targeting where we think price is going to draw to. And so after a move like this, we only have a small reach to hit this buy side liquidity. And so that's the direction that we're pointing towards. And so if we zoom in now to the 15-minute chart for the 10th of February, what immediately stands out is that we have a fair value gap here just after midnight New York time. So just keep in mind that when ICT sets up all of his charts, he's using New York time, and that's very important because he uses particular time zones to time entries. And so what we're actually talking about in this video is the ICT New York kill zone, and so that is the 7 o'clock to 10 o'clock period. And so basically what I've done here is just quickly mark up midnight, so that's the start of the session, and then you've got 7 o'clock and 10 o'clock here. And so what we're looking for is a setup inside that period. And so if you look to the left, what you can see is we have a fair value gap here which is formed before that session. And so if we drew that across, we'll just quickly do that now, even if it's quite rough, you can see this is the area of interest that we're looking at here. So we have these candles trade down into this fair value gap before the market trades higher. And so this is the particular area of interest we're going to look at. And so to do that, we're now going to zoom into the 5-minute chart and start to see if we can find a setup. So we're going to zoom into our 5-minute chart now to see if we can start hunting for an entry. So remember, we have a bullish bias, so we're looking for higher prices, so we're looking for bullish setup. So if we look to our left, we've still got a fair value gap on the 5-minute chart here, so you can see that 3 candle setup here, and if we draw that across, you can see these candles here, which is our area of interest, fall inside that fair value gap. So if we look at what the price action does, you can see we trade down low, and this low takes out this swing low, we have this high, and that takes out this swing high. So therefore we have the conditions that we need to start looking for a trade setup. And so if we run a fib from that low to that high, around that 50% midpoint is where we're going to expect to see that fair value gap as we start to tighten down the time frame. And so now if we zoom into our 3-minute chart, that's exactly what we can see. So if we look now at that fib, you can see at that 50% mark, there's our fair value gap right there. So remember, it's our 3 candle setup, 1, 2, 3, and the fair value gap falls across the body of that second candle between the high of the first candle and the low of that third candle. So you can see we have our fair value gap to the side here. The market trades down into that zone before trading higher. And so remember, to get set on this particular setup, we'd be looking at place our limit order to buy at either the low of that third candle or somewhere in the fair value gap, with our stop down here at the low here of the first candle. But keep in mind, you do have that flexibility to put it at the swing low, so you could put it at this low or this low here. So that's really ultimately just a personal preference based on your backtesting results and what your personal risk tolerance is. And you can see if we'd taken this trade, it would have been a pretty easy 3R setup. So assuming we'd gotten set there at the low of that third candle and we'd put our stop at the low of that first candle, you can see we would have picked up an easy 3R on that particular trade. So this little bonus section is on the ICT London kill zone. Now ICT doesn't go into a lot of detail into this in lesson 8, but I thought I'd throw this in as just a little bonus. So if we look at the setup here, the ICT London kill zone is between 2 o'clock and 5 o'clock. So again, remember, we're talking about New York time. So we have midnight New York time here, 2 o'clock and 5 o'clock, and this is obviously prior to the New York session. So remember, we have a bullish bias going into the 10th of February, so we're looking for long setups. And we're looking for them specifically in this ICT London kill zone. So if we look closely on the 3-minute chart, you can see we have a small fair value gap right here. And that fair value gap is between our displacement low and our displacement high. So you can see I've marked those out here. So we have a run down into that sell side liquidity down here. So this is our displacement low. The market trades higher before trading down. This fair value gap is formed. The market trades higher, so this is our displacement high, and the market trades sideways for a little bit before trading back down into this fair value gap before trading higher. So remember, to get set on this bullish fair value gap setup, we'd have our limit at the low of the third candle, and we'd have our stop either at the low of the first candle, or we could also pick the swing low. So that just again comes down to your risk tolerance and what your back testing has shown you. And so if we'd taken this trade, you could see we would have got a really easy 3R return all the way up to, maybe a 5 or 6R return, just depending on how patient we'd be. And this is largely because we've got a really tight entry here because the risk is quite small, and then we have quite a big movement running into the end of this ICT London kill zone part of the session. I hope you enjoyed my review of ICT's 2022 mentorship program lesson 8. In today's video, we covered high time frames, looking at the daily chart on the Euro Yen just for something different, and we also introduced the ICT London and New York kill zones to look for trade setups and trade entries. So I hope you found this video helpful. If you did, it'd be great if you could like it, because that helps other people to find it. And if you'd like to see more videos like this one, please make sure you subscribe to my channel. Thanks for watching, and I'll see you on the next video.